Okay, mastering Bollinger Bands. In this video I'm going to show you how to master the use of Bollinger Bands to identify high probability trade entry and potentially exits for stocks, options, and Forex. If you use the techniques that I outline in this video, it will definitely enable you to find some very high probability trade entries. There's 5 main signals that we're going to cover. There's variations to the signals, and I'll cover a couple of them. But all of them are based on, and this is where a lot of people make the mistake with Bollinger Bands, but it's based on approaching price action with a look at both bands. Doesn't matter which way it's approaching. If price is approaching an upper band, you're still looking at both bands for clues as to what price is going to do next, because that's the point. We're trying to forecast price movement. So we have 5 main signals. First one is the constriction, the most I don't want to say the most important, but probably the most famous of the signals is constriction, and that is decreasing volatility. When the bands come together and are not indicating any point of coming apart, they're constricting. And you can see here that unless the average daily range reduces more than it is now, it's not going to get any more constricted. So this is the constriction, and what we're looking for here is an expansion of the upper and lower band, meaning both one is going to head up, one is going to head down, and that's going to indicate to us an expansion in volatility, and we're going to look to enter this trade either long or short, and that depends upon a couple things. So we'll cover that in just a second. Here's the bullish expansion. Okay, we can pretend that it was a constriction at an earlier point, maybe not as tight as the one we used in the last example, but here is bullish expansion. And what's going to happen here is price is going to walk along the upper band as the upper band heads up. And what's critical for bullish expansion is that the lower band is heading in the opposite direction as the upper band. This is an ideal signal right here. We begin to move out of the contraction phase, and the upper band heads up and the lower band heads down. Ideal entry for a long position. The sharper the turning of the bands, both of them, typically 99% of the time, the more volatile the move. Okay, there's a couple things that we need to look out for with the bullish or bearish expansion, but we won't cover them right now. And then there's the bearish expansion, which is just the opposite. We have, you can see on this first bar, and the bands aren't as close together as they might be in a real example. And this is actually pretty typical, but you have your bars approaching the lower band. Then the lower band begins to head what I call south, and the upper band heads north. Okay, they're opposing each other, heading in opposite directions, which is an indication of expanding volatility. Price is down on the lower band, which is an indication that price is going to move down in that direction for a time. If this is a daily chart, the time frame that this move will take place will be longer, of course, than if it's on a 1-minute or a 5-minute chart. Okay, so the move is relative to the time frame that you're looking at. Just think about that. It's kind of a common sense. So here's a bullish move up where we have some expansion, and this is what I want to point out to you, why it's critical that you look at both bands. So we have constriction, okay, in the earlier 1 and 2 and 3 bars. Then our upper band begins to head up, but our lower band, instead of heading down and expanding, we can see that the lower band is heading up with it. Now, with the upper band. So the lower band is moving up with the upper band, so we don't have extreme expanding of volatility, but if you look closely, the bands are still separating, but they're not separating as extremely as they are in the other examples. And this is still a bullish move up, but again, we're looking at the bands, and we're looking at their reaction to approaching price action. And in this case, as price approaches the upper band, it moves up, which is bullish, but we don't have the expansion that we like to see. So pay attention to this because it's important. It's still a bullish move up, but you can anticipate the move is not going to be as extreme or as lengthy as the other examples given. Okay, so again, we're looking at both bands to get a clue as to what price is going to do, so we can forecast movement. This is still a good entry. It's just a more short-term one. Same with the bearish move down. Again, we have price along the lower band. In the beginning, we have constricting volatility. As price moves, we do see a little bit of expansion, but the upper band is following the lower band, which tells us that volatility is not expanding like we'd like to see it. Maybe some of you would skip this move, but maybe not. It just depends. The move is probably still going to take place, but it's not going to be as big. You might consider a 1 or 2 candlestick time frame in a move like this, and that just depends. Okay, here's a typical variance. Again, we want to watch both bands and the reaction to approaching price, both bands. So I show you this because in this example you have this is what you're going to see a lot on a chart. You're going to see the bands more apart. You can see in the earlier stages of this development, first 4 candlesticks, we had price, the upper band moving up with price, and the lower band was kind of flat, and around the 5th or 6th candlestick you could see that price, the lower band, began to move down. Okay, one might have found entry there depending upon other factors, okay, overbought and oversold conditions, but one might have found entry there because we do have, although not extreme, we have bands that are pulling apart from each other. One's headed north, one's headed south. Now the upper band will be headed more north, and the lower band is headed less south or less down. So they're not parting, extremely, but they are beginning to part here in about the 6th candlestick. Now, as price moves up the upper band, the upper band starts to head up. Price begins to move up with the upper band, and then we see the lower band start to move in the same direction as price, which is just an indication that lower band following price with the upper band is going to slow the move down. Okay, so keep that in mind. And if you watch both bands and approaching price action and the reaction that the bands have, the lower and the upper, to approaching price action, you will do extremely well, and you'll have a great understanding of Bollinger Bands. In this few-minute video right here, you'll have a better understanding of Bollinger Bands probably than any book you could read in Barnes & Noble. Here's my last variance, and it's an expansion variance. And again, the bands are far apart to begin with, but we can see about the 3rd candlestick back, maybe right about where I had the last 2 candlesticks. We can see that the upper band has been headed up. The lower band has been following it in the past. Okay, there's still some expansion going on, but it's not extreme until right now where the lower band starts to turn downward. Okay, and this is a case, it's kind of a late expansion case, but because volatility is expanding, we can expect somewhat of an explosive move. Okay, so watch those bands relative to approaching price, and you can develop a great system around Bollinger Bands. So these are the main indications with Bollinger Bands that you can use extremely effectively because you're measuring volatility, and if you look at both bands relative to approaching price, you'll be much more successful with Bollinger Bands. Hello, Mark Deaton here with bollingerbandgenius.com. My website, Bollinger Band Genius, is where you can download 6 videos and a workbook on how to trade Bollinger Bands. But what I'm going to show you in this video right now is all you need to make a killing with Bollinger Bands. It might be a little fast, but you can always use the pause button. I'm going to show you step by step a system that I used to turn $500 into a boatload of money. You can do the same thing if you just follow the steps, pay close attention, and limit your trades initially to 50 or $100 a trade. Again, provided you follow the rules. Let me cover the rules first, and then we'll go into the charts and I'll give you some examples. Okay, I titled both of these long trend entries and short trend entries for a reason, and that is because you need to make sure that you are trading with the trend. And that's the way this little system was designed. For our long entries, again, trading with the trend, we're looking for a swing low below the 21-day moving average. We're going to set our stop below our entry or below the swing low, which I'll cover in a second. And then we're going to exit on a minimum of a 3-to-1 return. For stocks, that's easy. For options, I'll show you the formula I use. Our short trend entries are just the opposite. Swing high above the 21, stop above the entry. I should change that real quick because that's not exactly how I do it. There, easy as pie. So our stop is below the swing for the long entries, and our stop is above the swing for short. Okay, everything else remains the same. So let's take a look at what I'm talking about. For the example, I'm going to have to go to current day's data to show you the option chain. Again, the most critical component of being successful with turning a small amount of money into a large amount of money, and then when you've got a large amount of money, it's just as critical for your long-term success that you manage your money properly. I'm not going to go into it completely, but I'll show you how I made sure that I was able to slowly build a $500 account and turn it into a large amount of money. My money management rules changed as the account grew, but initially I'm going to show you some of the steps that I followed. Let's go take a look at a chart real quick. And here's what we're looking for. We have a trend direction that's up right here. We have a swing low below the 21-day moving average, and our entry is this candlestick right here. This is Apple Computer, and then we just kind of shot up. We didn't get anything over here on the short entry, but let's look at another one. Here's another one with trend direction up. I don't know how long it was up. One way I look, there's a few things I look for as far as trend direction. Okay, one of them is, are we closing above or below the 21-day moving average? In this case, we're closing above it. Okay, here we're closing below it. Here the trend is down. Here the trend is up. Here we don't know. There's only one candlestick, but we can see that yes, it's up again. So here's an entry. We have a swing low. A swing low is a low, a lower low, and a higher low. And then we enter on the close above the first candlestick. Okay, so that we'd enter not until right here, this candlestick right here, closed above the first candlestick. Okay, so once we get the close above candlestick number 1, which begins our swing low, that's where we enter. A swing low is for long entries, and a swing high is for short, although this doesn't qualify here. But here's an entry, and here's a move. We our exit target is based on the amount of money we risk. If we, for example, got to this candlestick right here, and it was time to exit, then we exit. If we still see continual bullish movement, you have the option of staying in and reaping larger rewards. Okay. Here's a swing low. Okay, still coming off of a strong trend. We have a low, lower low, and a higher low, and this thing didn't quite close above the high, but it did right here, where we'd enter and make money again. Okay, so your entry is after the high of the first candlestick. Let's go take a look at the end of this. Because for me to give you a real-time example, we have to look at this right now. So let's pretend like this swing right here, this low, low, and higher low, was triggered below the 21-day moving average. This would give us entry right here. Actually, it would be so in this candlestick, but let's just kind of give you an example here real quick. What we want to do is put our stop just below the swing. Okay, so our stop's going to be below the swing. You know, we could go a little higher, but let's just say it's 180. Okay, again, here's a perfect entry right here. Low, lower low, higher low. Entry is right here at the close of this day, and our exit's going to be somewhere in here where we have a justifiable 3-to-1 return on the amount of money we risk. Now we're going to go look at how we calculate the money we're risking in an options trade. It's simple. We have a stock price of $190.51. I selected a $200 strike in the options chain, which was not just out of the money, but one a little bit more out of the money. I call it 2 legs out of the money. Our stop is 180 as we looked at on the chart. Our delta is 42. So here's what we do. If our stop is 180 and our stock price is 190.51, we're risking $10.51 as far as stock is concerned. But if we want to calculate what we're risking as far as the option's concerned, we're going to take that 1051 and multiply it times our delta of 42. So we go 1051 times 42, and we get $4.41. Okay, so we're risking 441. If we take 441 and multiply that times 3, we get 1323. Okay, not 2208. We get 1323. But if we take that 1323 and add it to the premium of 885, we get 2208. So our target is 2208 on the premium. That means when this premium hits 2208, we get out. The only other way we get out is if we hit our stop at 180, which means we will have lost 441, which is at about 50%, almost exactly. Okay? So we're looking to make, if we're going to risk 50%, what do we want to make? We want to make 150% minimum. Okay? And that's how you calculate your option. You stick to this formula, and you will make a killing. Another thing is this. If you're going to trade $500, when I started out with $500, number one, I was very aware of trend direction, and I made sure I was trading with the trend. Okay? I only traded about $75 to $100 per trade, and I would initiate 5 trades, 4 trades, whatever I could afford. And the beauty of a couple of my trades making me a 3-to-1 is that every time I made a profitable trade, it erased my last 2 losers. So starting out small is fine, as long as you follow a proven formula. This works. Good luck. Again, if you want to know more about how to use this, I've got 6 workbooks, 6 videos and a workbook you can find at my website, bollingerbandgenius.com. It's www.bollingerbandgenius.com. Thanks.